Coming up in today's show, stocks finish out a strong week higher, why we could get a year-end rally, how the Fed could upset investors next year, oil bounces back on new Saudi plans to extend production cuts into next year, what the contrarian trades for next year will be, including Chinese tech giant Alibaba, and why I think the S&P 500 is just about to break out to new year-to-date highs. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I'm your host Jared. I'm going to run you through all the most important news, data and charts across financial markets today. Summarize the week for you, what's going on and what we can expect next week. And there's a little bit of a mixed day to finish out the week on Wall Street. It's actually mega cap tech, the softest performing group today. And on the back of those new plans from the Saudis to cut oil production into next year, we saw a rip in crude along with energy and oil and gas stocks leading the pack today, and also financials doing pretty well along with some industrials as well. And just switching the heat map over to the weekly performance, just so you can see how the market as a whole performed this week. We had a lot of big breadth thrusts, a lot of moves up on big volume. Some of the semiconductors, Intel up 12.7% this week. So big moves up in the financials. Bank of America up 8.3%. Tesla had a good week, up 9%, as did industrials and REITs as well on the back of pullback in yields. And there's a look at the daily S&P 500 chart. Just really calling up here on a low volatility day, only finishing slightly higher. And this mega cap 8 was the softest group, down 0.29%, with the old economy stocks and Dow Jones coming off a little bit, and smalls put in a good day. The Russell up 1.37%, and the winning group was microcaps up over 2%, and we've now bounced more than 10% since we made those lows on the 27th of October. However, stick with me because I'm going to come back to the charts later on and let you know why I think we could be making new year-to-date highs next week above 46.07. I'll give you my reasons why I think there's a good chance that may happen. First, let me take you through all the news and data and get you up to speed. So the theme this week across financial markets is pretty much stocks and bonds concluding that the Fed is done hiking rates, now actually assigning a 100% chance that they're done, and even given a little bit of chance we may see a cut come March or May next year. And that's caused a huge rip in the stock market, going from technically oversold to overbought in short fashion. And we're seeing quite a good improvements in breadth and a lot of volume coming into the market, especially small caps and micro caps coming off beaten lows. We put in some good divergences and a lot of stocks getting back above their 50-day VWAP. And this is coming into a seasonally bullish period as well. And so looking back in history, when we get all of these patterns, that typically means there's more gains ahead. And looking at all the economic data we've been getting in this week, it's just more music to the ears of stocks and bonds rallying up as it's been coming in softer than expected and kind of cementing the view that the Fed is done, and almost as if the market's expecting J. Powell to come out on the 14th of December and officially declare they're done as well. So not only are inflation expectations coming down, the now cemented view that the Fed is done. We've also had Q3 earnings coming a lot better than expected. Analysts as a whole were expecting flatline growth. They've actually come in a bit above expectations, showing about 4% year-over-year growth, with more than 80% of stocks beating estimates. That's above long-term averages, and the size of the beats a bit above long-term averages as well. So clearly the economy surprised a lot of us this year, especially after the regional banking crisis in March. It has held up really well, and once again markets go for further and longer than you think. And so the backdrop is there for a classic year-end rally. And don't get me wrong, whilst I think the stock market could rally for a couple of months, like it typically does when the Fed goes on pause, I'm still bearish medium term, as I still think it's likely the uninverted yield curve plays out like it does every time, and we get a recession next year, which should crater the stock market, and then we may get a real bear market. However, for now, there is quite a bit of bullish momentum in the market, and it could be going into that Goldilocks period of de-accelerating inflation and the view that interest rates have topped and going to turn back down, along with expanding corporate earnings on top of bullish seasonality. And we've even got some indicators of growing consumer confidence, with a record number of US consumers planning to vacation in a foreign country in the next 6 months. And after that fell off a cliff during COVID, down below 5%, there could still be a bit of pent-up demand out there to go on holiday and travel. Now got almost 1 in 4 Americans wanting to travel overseas in the next half a year. And when people travel, that's typically a sign they're feeling good about their finances, as it's not a necessity, it's a real discretionary item. And so just another sign that right now the consumer's still okay, unemployment's still historically low, below 4%, and these high rates don't seem to have fully bitten the economy and consumer just yet. On the other side of that, we've got the usually bullish fund strat, saying the stock market looks overbought, and this week's stunning rally could soon hit a wall, and the short-term risk-reward for equities is declining. And that's Mark Newton writing the odds favour an initial stall out near the Thanksgiving holiday, with him going on to say what's abundantly clear when eyeing equal-weighted iShares S&P 500 ETF charts on weekly timeframes is that this bounce is just below an area of very strong resistance, as the breakdown has now rallied back to test this prior area of former support. And I'll show you a bit later on the charts exactly what he's talking about, as we'll look at a few weekly timeframes on the main indices to kind of see where we're at. But I'll come back to stocks in a bit. First, let's just look at the bond market. With it falling again this week between 10 and 20 basis points across the curve and finishing lower again today, especially in the long dated stuff, with short dated bond yields actually rising, setting yield curves deeper into inverted territory. And this has been reacting to the weaker than expected economic data as well. And now we're getting back to a bit of a disconnect between how the market's trading and what the Fed's saying, as Jay's still trying to sound a little hawkish and leave the window open to further rate hikes, and saying that cuts are nowhere near. Fed Fund futures are saying that they actually could be only 4 or 5 months away. And if that weren't to happen, that could truly upset the market. If we get some hot CPI prints, that would really pour some cold water on the stock and bond rallies we've had this last couple of weeks, as the market's saying definitively that inflation is going to keep tracking down towards 2% and the Fed is absolutely done. And we can see that in Fed Fund futures, not even giving the slightest of probabilities that the Fed could hike again. Actually given an almost 1 in 3 chance they could cut in March, and actually given a 63% chance that they will cut come May. And like I said, this price in here is a lot different to what the Fed's saying. Some Fed members are saying that they could maybe even need another rate hike, and rates are going to stay on hold for higher than longer. However, according to traders, they're pricing in a full 100 basis points of cuts next year, saying the Fed funds rate should be 4.25% by this time next year. And there's a look at the 2-year, bouncing today to 4.89, the 10-year losing ground a little bit to under 4.40, and the 30-year finding new multi-week lows down at 4.59. And just looking at a weekly chart of the 10-year yield, this is still obviously in a clear uptrend, high highs, high lows. And for us to stay in a good strong uptrend, we'd need to defend this level here, where we previously topped out around that 430. We're just a little bit above that now. And I'd say we could test that next week, and we'll be looking for that as the first area of support to hold. After that would be the big psychological level of 4%. Then we should see a little support around 380. However, for that to happen, we'd really need to see some more weak inflation data come through and better performing treasury auctions. Moving on from bonds to commodities. And if you've been watching my channel, you know I've been saying for a few weeks now, the Saudis are probably going to come out and extend their production cuts into next year. And that's exactly what we're hearing today, with rumors the Saudis are considering prolonging production cuts into next year, as reported by the Financial Times. And OPEC Plus is set to meet next weekend to discuss that. So we'll probably hear that next Sunday before the market opens. That sent the price of crude up more than 4% today. And it looks like we've got a bit of a bounce off that support zone I was watching, around $73 a barrel, and we could easily come up and tag the 50 days, probably somewhere around 80, 81, possibly next week before OPEC meets on Sunday. As I'd say, the Saudis and Russians want oil probably around $85, $90 a barrel as their kind of sweet spot to maximize profits. However, on the other side of that is weakening global demand and record production from the US, which are the biggest producers in the world, along with some other Western producers as well, pumping it out at records to counteract the supply cuts coming out of the Middle East and Russia. So we got an interesting research piece out of Bank of America today called 12 Angry Trades. It's just basically showing where the crowd is leaning strong one way and what the contrarian outcome would be. For example, 89% of people say geopolitical risk is above normal, so the contrarian outcome would be better geopolitics. Only 21% of people expect a hard landing for the economy, so the contrarian outcome would be we do get a hard landing. Only 6% of people predict higher inflation next year. That's super low. So like I said before, that would be a huge upset for the market. Only 18% of people expect higher long rates. Only 12% of people expect a stronger US dollar. And they've listed short China as the second most created trade, with the first most created trade being long large cap tech. So if you're a bit of a contrarian like I am, then the trades to take against the crowd for next year would be lower oil prices on the back of better geopolitics, something that could be happening after President Xi and Biden met together in a kind of thawing of the relations. The first time the leaders from the two largest economies have met in 7 years, and maybe even with improved geopolitics we still get a hard landing, which would lead to wider credit spreads, forced selling of tech, so junk bonds that have been holding up really well could crater. We may get higher inflation, in which case inflation protected bonds would do better. The Magnificent Seven may actually underperform next year, and China may actually find a bottom after being in a bear market for several years. And that brings me to my next point, something I've been looking at today to potentially start a new long-term position in, is that of Alibaba, as the stock's kind of done a little mini crash over the last couple of days. on the back of them having to abandon the spin-off and IPO of its cloud computing division, which I don't think is a long-term material bad thing for the stock. Obviously, it's still got a lot of problems, and the Chinese government's clamped down on their largest companies, and the markets at large over the last couple of years could be bottoming out, because like we saw Xi in San Francisco talking to American business leaders, I think he recognizes he's gone too far and wants to claw it back a bit, and is inviting investors back into the Chinese market, and they're doing a bunch of stimulus in the country and may want to see a healthier stock market. And just looking at a clean weekly chart of the China 50 index, kind of their equivalent to the S&P500, you can see after that peak, a bit above 20,000 in early 21, it's fallen over the last 2.5 years, now down trading under 12,000, coming off a bit more than 40%, and just maybe it can make a double bottom and find a low here, and this market could be getting close to being de-risked. And it's for that reason I think Alibaba could be setting up for a contrarian play here, as we've fallen a bit over the last couple of weeks, now trading at $77 a share, and believe it or not, that's below where it IPO'd almost 10 years ago in September 2014 at $92 a share. And in that same period of time, revenue's grown from $8.4 billion to $126 billion. Also catching my eye is the large amount of cash they've got on the balance sheet, now currently standing at $13.16 per share. And so if you take the current stock price of $77.60 and subtract their $13.16 per share in cash, that gives us a price of $64.44. Then if we divide that by their trailing 12 months earnings per share of $7.27, that gives us a price to earnings ratio excluding cash of 8.86, which is an earnings yield of 11.28%, which I think is a reasonable risk reward here, as I think we're probably closer to the bottom than the top. And President Xi and his government are pretty good at getting their way when it comes to domestic issues, as they have near total control. And he didn't like how big Jack Ma had got up here and was starting to get a bit more social influence along with their other big tech companies, and he saw what was happening in America. So he wanted to knock them over, which he did pretty good. However, I don't think he wants to kill his own stock market and biggest and best companies completely. I think he's cut them down to size. And the feeling I got from his speech the other day is that he really doesn't want a war with America. I'd say the chips ban is affecting them, and he wants to come back to the table and do business, and probably wants his own stock market to do a little better, as well as they've got problems with youth unemployment, big problems in their property sector, and just a weak economy overall, with much lower growth rates than what they've been used to over the last 20 years. And technically speaking, we look to be put in a broad bottoming formation and at the bottom of this range. And just taking you down to a daily chart, it's only 3 days ago we were trading at almost $88 a share. Here we are now at 77. So it's a really volatile stock, and my stock fair value indicator likes it as well. It's got fair value at $111 a share. And just looking at the largest holders of Alibaba's stock, large hedge funds, asset managers, investment banks like Morgan Stanley, JP Morgan, Sidel, Goldman Sachs, they've all increased their positions in the stock in the latest reported quarter, which we just got a few days ago. So a lot of Wall Street's accumulating. They're going to want the price higher. Wouldn't be surprised to see some upgrades over the next month or two, some positive stories come out throughout the media. And if you've been watching my channel, you know I've been bearish on China for a little while now, but I can't stay bearish forever. And like I said, the risk reward could be setting up here. It could get a lot worse before it gets better. It's not just going to turn around in a few weeks. However, that's why I'm looking to add Alibaba in the mid-70s to my long-term portfolio, just a small position that I may continue adding to if we continue trading down into the 60s or 50s, as I think it could be turning into an asymmetrical bet with a lot more upside than downside, as the stock's down 76% over the last couple of years. And if we would eventually get back up to those levels over the next couple of years, that's about a 315% return. And for as large as the Chinese economy is, the second biggest in the world, I'd say their biggest internet company should have a market cap more than $212 billion like it does now, because the American equivalent, Amazon, has a market cap of $1.5 trillion. That is more than 6 times larger than Alibaba. So I think that gap is likely to close over the next couple of years, because I think the CCP is changing their tune, and we may just be close to a bottom in the Chinese stock market. Moving on, just looking at the calendar coming up for next week. Still got a bit of Q3 earnings to get through. We'll hear from Zoom on Monday. Got the leading index economic data, along with the big one, Tuesday, NVDA earnings. Be really interested to see what happens there. They're trading near all-time highs. Along with John Deere on Wednesday, jobless claims, consumer sentiment data, and then we're pretty much wrapped up for the week. on a shorter trading week thanks to Thanksgiving holiday on Thursday. Markets will be closed all day, and then we close early on Friday at 1 p.m. Just looking at economic data we got today. Retail sales in the United Kingdom a lot weaker than expected, down 2.7% year over year. Inflation data in the Eurozone coming in as expected, 2.9% year over year growth. And some housing data coming in a bit better than expected in the States, with building permits growing 1.1% month over month, better than the contraction we were expecting. And same with housing starts growing month over month versus the contraction we thought we were going to get. This market's finally now getting excited with the fear and greed index moving back into the greed zone for the first time in a while. And even though we're just gone into the greed zone and we could be getting close to a short-term top, I still think there could be some room to run, as we're not really that high on the fear and greed index. And looking at some other things too, like the AAPL investor sentiment survey, with the bullish reading at 43.7%. The last time we topped in the market, that went above 51%. And there might still be a bit of catching up to do with money managers, because looking at the 4-week moving average of active investment managers exposure index, that's still relatively low at 46.95. Again, when we last topped out on the market, that was at 94%. So positioning still a little light here. And even though my institutional buying percentage indicators still slightly bearish at 44.22%. Once that goes above 45%, that's neutral in the orange zone. Just like the S&P 500 oscillator, which is still in overbought territory. Sometimes it can stay overbought for a few weeks like it did back in July, because looking at the S&P 500 oscillator, typically it's a stronger signal when we just bounce off there sharply. Looking back last times it's got up there and turned quickly, the market's turned with it. However, sometimes, like a lot of technical indicators, they can do what I call walk the line, like we got back here in June, where it kind of just hovers around there in that overbought territory. The market can keep drifting higher with it. And I think potentially that could be happening here. Like on my buy-sell bend, if it touches it and pings off, that can be a good sign of reversal. However, it can kind of walk the line and kind of hug it for a while. We saw that back here in early June as well, kind of just hugging the top of the line there. And we didn't get the divergence on the DSI or my hidden divergence indicator, which we're not getting now either. My DSI is not diverging. It's actually kind of moving up and holding steady and hugging it. And same with the hidden divergence, kind of holding up there. And just looking at this candlestick pattern, that's a bit of a bull flag, that big gap up, which could be a runaway gap, and then it kind of just holds and coils up. That's a bit of a bullish pattern. And so these technical reversal signals could get rejected. And again, when we close above them, that rejection is a confirmation of further momentum, which the stock market has a lot in the last couple of weeks with these big thrust moves. And I'd say we're just drawn to those year-to-date highs at 46.07, where I've just put this line in here. And the market will just want to come up and have a look there. Whether we get a genuine breakout or fake out bull trap, I'm not sure. We'll just have to wait to the price action if we get up there next week. And I know that's another 100 points away in the S&P 500, but I just think with this momentum in the market and the way the technical indicators are starting to look now, doesn't look like we're getting that reversal. Like I said, that normally pings off straight away. And what's kind of adding to my thought that we may break out to new highs next week is the volatility risk premium from option dealers. Still asking for less premium and implied volatility versus that of realized volatility. And option dealers have a pretty good record of pricing the market, and so they're really not worried here. They're really chill. We can see that in the VIX as well. Another classic Friday in the VIX. Now falling to below 14. And once again, that just looks like we're drifting lower. And that can go on a lot further than you think. And just kind of sit there for a while like it did back in June going into July. Until we finally topped in the market and then we get that bounce off. And just looking at the Russell 2000, that's coiling up and hold after that big volume thrust up, gap up. It's held here. That's looking like a bullish formation after those strong bullish divergences we got down here. And so like I said, medium term, while I'm skeptical in this market due to valuations, possible recession next year, short term going into year end, I would not be surprised to see the market keep ripping higher, and who knows, maybe we even hit 4,700 before Christmas. Because even though we look really extended here, markets can quite often go higher for longer than you think and are pretty good at surprising a lot of people. And like we saw in manager positioning, not everyone's on board this rally just yet, with the fear and greed index still not that elevated around those 70, 80 levels either. And for clues on that, keep watching the 10-year yield. If we keep pulling back in yields, that's going to help the stock market, along with oil as well. If that continues in a downtrend, that's going to keep inflation expectations coming down. That should help the stock market too. Just looking across international stock markets, there's Canada's TSX having a nice rally off a bottom. FTSE still looks like in a sideways pattern, and German's DAX had quite the rally this last couple of weeks. And China's 50 index still looking flat there, still has a lot of work to do technically before we can really get excited, but like they say, it's always darkest before dawn, and I prefer to try and buy cheap things before everyone's buying it and talking about it, which could be the case here with China and Alibaba. There's a Nikkei 225 close to breaking out to new year-to-date highs, and the Aussie 200 just kind of like the FTSE, trading a little flat there. Short-term breadths holding up really strong, 86% of stocks above their 20-day average. You can see those big breadth thrusts we've got over the last couple of weeks. Really violent moves off the bottom, more pronounced in the amount of stocks above the 50-day average. Big strong moves up in the market. There's a lot of weight and volume in that. Typically that doesn't just fall over straight away. And a bit of improvement in breadth as measured by new highs versus new lows. Kind of getting back a little bullish there, and on the Nasdaq as well. And we've seen a good move up in high beta stocks versus low volatility stocks. Stuff that had been beaten down has jumped pretty good. And there's that inflation expectation spread coming off these last couple of weeks. And TLT once again finding higher highs, higher lows. Now trading at 7-week highs. And this could very well be the bottom here after this big bullish divergence. A lot of volume coming in here. And once again, stocks are trading in line with bonds on the widely held view that the Fed is done. High yield bonds as well. Really good indicator for risk appetite in the markets. That price action is super strong. And helping that is a weakening dollar. That's looking like a real bearish pattern. Could be going into a strong short-term downtrend here. And we can see that in the euro turning up, trading more stronger against the dollar. And even as battered as the Japanese yen has been, we can see the dollar is stalling out in this big resistance zone versus the yen, and it just closed back below the 50-day VWAP for the first time since late July. There's Bitcoin just kind of holding ground above this new support zone, we think, at 36,000, and Ethereum just pulling back. Still got a bit more work to do before that breaks out to new highs in a clear bull market, and a bit of a bounce back in the commodity index thanks to the bounce in crude. And the second best performing commodity today, uranium, breaking out to a new year-to-date high. And look at that weekly chart. That looks like a bullish pattern to me, and you guys know I've been bullish on uranium all year. I think it's coming back as the number one clean energy. If done right, I think it's more efficient than uranium, and had been written off by a lot of the world for the last decade or so, since the Fukushima accident in Japan in 2011. However, with Russia trying to hold Europe hostage to their energy, there is more and more growing interest politically to come back to uranium. And I think a lot of people underestimate how powerful uranium is. If you study evolution, life was pretty much started from a uranium geyser, and could very well be the most powerful element on this planet. And just taking you out again to a monthly chart, look at that huge fall since Japan in 2011, bottomed out for years. Now it looks like it's just waking up, and I would not be surprised to see this thing rip a lot more over the next couple of years. So I continue to remain bullish on uranium. The price of orange juice at all-time highs, and just taking you out to a monthly chart, look at that rip over the last couple of years on orange juice. That is a huge spike. Same with sugar doing really well, and cocoa as well. Agricultural commodities have definitely woken up this year, and that's an area I've been positioned in over the last couple of years as well. Over to stock sectors, it was the cannabis ETF, the winner again today, finishing up over 7% on highs. Hopefully somebody knows something and is front running a rescheduling from the DEA, taking cannabis from a Schedule 1, where it currently sits with things like heroin, to a more relaxed Schedule 3. That should pave the way for more legalization. Hopefully Safer Banking Act can go through Congress, and this continues to trade higher after we got that nice bounce late last month. There's the bounce up in ARK as well. Overvalued stocks still doing really well, and retail, strong bounce there on volume, along with biotech after being beaten down really hard. And a little bit of softness in REITs, healthcare, and staples, with utilities and dividend-paying stocks still holding ground above the 50-day VWAPs on the pullback in bond yields. There's the BlackRock barometer, price action I look for clues on the health of the stock market. Doing really well this last couple of weeks, bouncing almost 20% off lows from late last month. JP Morgan trading really strong, looks to be walking the line up here as well. And a bit of softness in mega cap tech, with the $1 trillion club pulling back today. Microsoft, Google, and NVDA kind of just sitting right near its all-time highs. We got earnings next week, and I know technically we're a bit stretched up here, but I really wouldn't be surprised to see a big fat green candle taking us above 510, 520, and a lot of people just thinking, what the heck is that? As its valuation is already so stretched. But like I said, things can go higher for longer than we all think. As Tesla just kind of holding ground, a little mixed in the meme space today, and we just got earnings from another retailer, Gap, coming in a lot better than expected. And once again, even in a VIX 13 market, we're getting these huge pops from these bigger companies, up over 30% today on huge volume. And just another sign that the consumer hasn't been knocked over just yet, still holding up there. Another climb again in Intel, trading really strong here, along with Sphere Entertainment back above its 50-day. And these old economy stocks we're watching, trying to hold ground here. General Motors up 2%, Walgreens up 2.2%, Macy's another great day up 8.3%. And once again, the telecoms just drifting slightly higher and low volatility with more good price action in those regional banks and the financial sector kind of having a really good bounce here off these lows the last couple of weeks. So just wrapping it up with S&P 500. Like I said, even though the last couple of days it looks like we could have been topping out, according to my indicators, we didn't get that immediate reversal and ping off that we typically see in these reversals. Can kind of form these V shapes. Otherwise, it can kind of just hug the top of the buy sell band and kind of walk the line. And I still think there's another big gap up green candle to new year-to-date highs. And like I said, I don't know whether that is a genuine breakout or a bull trap fake out, because I can imagine there's already a lot of people buying calls that would just explode up there. The fear and greed index would probably get really elevated to 70 or 80, and then we could put in a short-term top before we pull back and then do a bit of sideways consolidating action into the rest of the year. The market does do a great job at fooling most of the people most of the time, so we'll just have to see what happens. And just looking at the weekly chart in the S&P 500, that's the third week in a row. And just looking at the mega cap 8, that's looking pretty bullish there, like it's breaking out again. And the Russell with those big strong volume thrusts off the low, finishing the week up over 5%, and micro caps up over 6%. These big moves off lows can be a sign of a bottom, at least in the short term. And I'd say if we don't get it next week, barring any nasty surprises, I still think we flirt with these year-to-date highs before Christmas over the next coming weeks. Otherwise, that's all I've got for you this week. I hope you found some value in this video. If you did, please click that like button. Appreciate all your support. And make sure you come back to the channel next week. I've got a great Cyber Week special for you guys with not only my own products and services, but some other trading companies' products and services that I've partnered up with. I'm offering a great deal and a lot of value. I think a lot of you guys will find really beneficial if you've been looking to get access to some of the tools I use every day in these videos. Other than that, I hope you all have a great weekend, and I'll see you all again Monday night. Cheers.